Traditional fixed deposits offer a comfortable illusion of safety, steadily destroying your purchasing power through inflation. But escaping that inflation by dumping 100% of your capital into equity index funds exposes you to severe 30% market drawdowns that test the nerve of even the most seasoned investors. The solution is not to choose one extreme over the other. A resilient portfolio actively pairs high-growth equity with the stable preservation of gold. Think of them as mechanical components. Broad equity index ETFs act as your wealth engine, compounding corporate earnings over decades. Gold ETFs act as the shock absorber, deploying capital protection precisely when the engine stalls. This split-screen graph demonstrates the math behind inverse correlation. Because equity and gold react oppositely to the same macroeconomic triggers, a drop in your stock holdings is often offset by an automatic spike in your gold value. To build a portfolio that actually survives the coming decade, we need to evaluate these assets across a specific 10-topic masterclass framework. You can stop trying to pick a winner between gold and equity. True psychological peace of mind comes from structural asset allocation, letting math do the heavy lifting. This side-by-side comparison outlines our first topic: mutual funds versus exchange-traded funds. By passively tracking an index, ETFs strip away the high expense ratios of active management and allow you to trade units in real time on the stock exchange. That efficiency requires you to take the wheel. You must maintain a demat account and take absolute responsibility for your own allocation and rebalancing. Topic 2 focuses on our engine, equity index ETFs. Purchasing a single unit of a Nifty 50 ETF grants you immediate proportional exposure to 50 of India's largest companies. By tracking the entire market, you capture the full upside of national economic growth. The mathematical trade-off is that you are also guaranteed to absorb the full downside of every recession, correction, and market panic. Over a 20-year timeline, those equity returns are mandatory for beating inflation, but the sheer volatility of a standalone equity portfolio makes it incredibly difficult for most investors to hold during a crisis without selling in a panic. That brings us to topic 3. Gold ETFs. They serve as a crisis anchor, allowing you to hold digital gold without paying heavy jeweler-making charges, renting a locker, or worrying about theft. You don't hold the physical metal yourself. Instead, you pay a small expense ratio, around 0.5% annually, to custodian banks who securely store the physical gold bullion that directly backs your digital paper units. Topic 4 introduces debt ETFs. They replace traditional fixed deposits by offering a flexible income layer with high liquidity and competitive yield potential. The current tax reality for debt ETFs is strict. Regardless of how long you hold them, your gains are added to your overall income and taxed at your specific SAB rate, with zero indexation benefits. Topic 5 looks at the long-term alternative to gold ETFs, sovereign gold bonds, or SGBs. SGBs pay a guaranteed 2.5% annual interest bonus on your initial investment, and capital gains are completely tax-free at maturity. The cost for those perks is severe illiquidity. Your capital is locked up for 5 to 8 years, and trading them on the secondary market can be difficult. If you need to rebalance dynamically or access your cash in an emergency, gold ETFs are the practical choice. SGBs are strictly for patient, untouchable wealth. Topic 6 addresses market volatility dynamics. When geopolitical tensions flare or inflation suddenly spikes, fear drives institutional investors to liquidate broad equity holdings, causing rapid market drops. In those exact moments of panic, capital historically flees to safety. Demand for gold surges, pushing its price up right when your equity portfolio is bleeding red. Looking at this waterfall chart brings us to topic 7, the tracking error trap. This is the invisible gap between the theoretical return of an index and the actual return that lands in your demat account. Even a minor tracking error of 0.5% severely degrades your final wealth when compounded over a 10 or 20-year investment horizon. Gold ETFs generally track their index very tightly, though they experience a slight drag from vault storage fees. Equity ETFs, especially in mid or small cap sectors, can deviate further due to stock liquidity issues. Selecting an ETF requires you to audit its internal efficiency. A poor tracking error quietly cannibalizes the returns you took all the market risk to earn. Topic 8 covers the 2026 tax reality. For both equity and gold ETFs, you must hold your units for 12 months to qualify for long-term capital gains tax rates. This comparison matrix details the nuances. Both assets face a 12.5% long-term tax rate. However, equity ETFs grant you a 1.25 lakh rupee annual tax exemption, while gold ETFs offer no indexation benefits whatsoever. Topic 9 highlights liquidity. Because ETFs operate on a T+1 settlement cycle, you can liquidate massive positions into your bank account within 24 hours. Try doing that with real estate or physical gold bars. But that supreme liquidity is a double-edged sword. When it only takes 2 taps on a smartphone to sell your entire portfolio, the urge to panic sell during a temporary market dip becomes a massive psychological hazard. That brings us to our final parameter, topic 10. Mixing assets. You hold these different ETFs in a single demat account, specifically because of non-correlation. This scatter plot visualizes the historic negative 0.15 correlation between gold and equity. Mathematically, they operate independently. When equity data points cluster downward, gold data points tend to cluster upward. Holding a portfolio of 85% equity and 15% gold shaves off a negligible fraction of your peak bull market gains. In exchange, it delivers profound psychological stability when the market inevitably crashes. With the mechanics clear, the final step is mapping these ETF vehicles to your specific timeline and risk tolerance. This flowchart maps out Profile 1, the aggressive wealth builder. If you are 20 to 30 years away from retirement, you allocate 90% to broad equity index ETFs. A 10% gold ETF slice acts purely as an insurance policy. Profile 2 is the balanced optimizer. If a 20% drop in portfolio value would keep you awake at night, you utilize a split of 70% equity, 15% debt ETFs, and 15% gold to drastically suppress overall volatility. Profile 3 is the income focus. Older investors, or those with very low risk tolerance, shift heavily away from equity ETFs, relying instead on sovereign gold bonds, fixed deposits, and highly stable large-cap indices. Execution today is entirely operational. Assess your personal risk tolerance, open a demat account, and automate monthly SIPs to maintain your specific ETF ratios. Gold and equity aren't competitors. They are defensive and offensive teammates. Execute them passively, trust non-correlation math, and let the portfolio build wealth uninterrupted.